giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby, and twist myself at the spine. Don't wanna overthink it, baby. It's just twist your body and mine. Baby, you give me ice and fire. You're giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, but I don't wanna jinx it, baby. Let's not get ahead of my time. Oh, but I don't wanna miss you, baby. So I stand up and speak my mind. Oh. Baby, you give me ice and fire. You're chilling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry.
What's up, everyone, and how are you all doing today? Oh, man. Rockin' and rockin' and rockin'. How is it going? All right, so today, what do we got? Today we got Jerome Powell going on the mic, and then he goes into his blackout period. For those of you that do not know, and for those of you that do know, well, we're going to talk about blackout period. Basically, they're not going to talk. They're not going to talk leading up to their rate decision so that there's no influential or influence on the market. Sorry, I'm just looking for my eyeglasses cleaning cloth, and I cannot find it. I rearranged the studio just a little bit, so like my stuff's kind of all rocked around. You guys can't see it. It's a different world around here. Good morning, Klaus. Thank you, Tony. Good morning to you as well. Mark Simmons is watching from the UK. Hello, Mark Simmons. Nico in the house. Rock on, Nico. So yeah, a little bit of Jerome Powell talk here, all right? So we're going to have some stuff going on. Jerome Powell set to come on at 12 Eastern time, okay? 12 Eastern time. So we're just going to hang out here until Jerome Powell goes on the mic. We're going to talk stuff. FedEx is here, says hello from Chile. XRP Firebird, what's up, guys? What's up to you? How is it going? Just got a little Fed stuff going on in the background. A little bit of noon action Eastern time is when the Fed comes on live. Got a question for you, for everyone watching right now. I've got a little bit of a conundrum. I've got a little bit of a question I want to ask you all. Your opinions. Digital Revolution in the house. Silver Dollar City. Nice. Silver Dollar City. Rock on. So here, I have a question for you. All right. My question is this. There is an auction coming up here at the end of this month, all right? It is my county's tax auction, right? The people that default on their taxes, blah, blah, blah. You could buy real estate, homes, lots of stuff, okay? Now, the thing is they got a list, a massive list, and this is the actual list up on the screen. Like, that's what I'm saying. There's tons of stuff. There's acreages, there's land, there's farms. There's just lots of stuff. Would you stop it? There's just lots of stuff, all right? Lots and lots of stuff to pick from. Developed lots, undeveloped lots. Well, anyways, the auction's coming up at the end of this month. And I'm sitting here and I'm thinking, all right, there's a few things that are close to me that I'd be very interested in. Larry B, what's up? And I'm looking at the list and I'm like, all right, cool. The problem is anything that you would buy from this auction, you have a year. You have to wait a year to take possession. So that's what I'm asking you. Is it worth waiting a year? And the owners can still buy back their stuff, by the way. The owners have 1 year. So this is a county auction in South Carolina. They have a year. So yeah, I guess my whole thing is, would you want money locked up for a year? Or would you want the idea to be, I don't know, more liquid, to have the ability to buy and strike when something comes here? Waiting a year for locked up money is not good. And this is kind of like the same thing with crypto, and that was going to be my segue with crypto, is that with locking up money in crypto, do you really want to lock it up for a year? If you don't think the market's going to boom within a year, do you want to wait for a year on making your money work for you? Twin Force Fusion says smash the thumbs up, like it. Please do. Digital Revolution says Black Swan, liquidity crisis, Caesar Ripple, fund exchange. You know, I will buy stuff with my deep liquidity. Yeah, and that's the whole thing. Is like, I'm in the mood to buy. I just don't want to put it on a holding period, the buy. You know, if crypto's going to take some time to moon, can you put some money here to work there? Can you put some money to work here sooner rather than later? Digital Revolution says you get a high rate of return and a good chance to own it outright. You do. It's a 1 year time period. And if they buy it out, they have staggered returns. So I think it's, if they pay the thing on the first 3 months, you get 3%. And I think through the first 6 months, it's 5%. Through the first 9 months, it's like, I think 6%. And then I think it goes to like 7 or 9 if they bail out on month 11. And then at the 12-month period, you get to take possession. But there's a lot of good stuff there. All right. And I guess I'm looking at is the list is huge, and there's some really good stuff. There's some big acreages. There's a workshop. Someone's got a workshop, an acreage with the workshop. And I've been like looking for stuff like this, and it's really close to me. And they got an acreage with just a workshop on it, and it's up on the sale. So yeah, I mean, I would have to put the money out, but I would be out, right, for the 1 year. Nico says yes, because you have more cash once crypto pumps. Then you could use that windfall to renovate the property, then flip it or rent it out for passive income. Yeah, no, Nico, I dig it, man. I dig it. I just don't like the idea of if I put money out, I have to wait 1 year to even be able to touch it. That's just and like, I get it, like with the CD, you know, and all that, you're guaranteed, and like, I get it, you're guaranteed to get that money, or I don't know. I guess like it also comes down to the price, like how much cash, how much liquidity are you going to be without. But just wanted to throw that out there with you. Buy only if it's dirt cheap. Also viewing from the UK, Darren Hampton. Thank you very much. Yeah, and that kind of was my thinking too. Was if it's the exact thing that I want and the price point is right, I could wait a year. And if at worst, the minimum, I make 3% on a short-term return within 3 months. Okay, that's not bad. That means I would get my liquidity back in 3 months. That means I would get my liquidity back come like February, somewhere around there. So, I don't know, just something to think about. But Jerome Powell is set to come on the mic. Jerome Powell should be hitting it in around 24 minutes. So we're all just hanging out right now, talking crypto, talking finance, talking life. If you've got questions, if you've got comments, now is the time to bring them up. What would you do, right? If you're sitting here and you're looking to invest, and you know you've got money set, you know, like chunks of money set aside for projects. Are you looking to turn things over in 3 months? Do you want to have more liquidity? Are you in it for some long haul? Hey, I could invest the money for years and not really give a crap. Is that too boring for you? Do you want quicker returns, more action, more volatility? I mean, let me know. What are your thoughts? What are your guys' appetites right now? I've just been looking at a whole bunch of stuff lately because a lot of asset classes are really overvalued right now. So part of me is even sitting here thinking, okay, cool. do I keep building more cash on the sidelines because maybe prices 9 months from now are going to be even less and I'll be able to accumulate more or be able to have bigger purchasing power? So there's just a lot going on. And I think the reason I'm bringing this up is because we're going to be listening to Jerome Powell and the Fed, right? Economic stuff. The reason I bring it up is that economic investing and blah, 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 is there's going to be a lot of people out there like me that are going to be going, okay, look, what market is the right market for us to make our play in 2024? Like, because think about it, that's kind of what this is all about right now, okay? If you're thinking of making moves for right now, you've already missed out on the train. We're talking 2024 hits, right? What are our hits leading into 2020, end of 2023 and into 2024? So there's a lot of people out there, and I've been in talks with actually several of you. We've been texting, yes, if you're watching on live stream. I don't want to say names, but we've been texting. Now, what are your plays? Are your plays in commodities? Are you sitting here thinking, hey, look, there might be a commodity play coming up? You know, with this Middle East action here, you know, Israel, you know, Hamas, you know, Gaza action, are we going to see the oil play happen? If the oil play happens, then I don't know. I think that would really kind of just blah the crap out of it, and you would just be... That would just suck in all the energy. So I guess we're talking finance, we're talking investing. What are your thoughts on near term here? Trick says top of the afternoon to you too, Trick. Nico says, I agree with Darren. If it's dirt cheap, go for it. Yeah, I get it. Yeah, but the whole thing is digital revolution. Like, I want to make something on the money soon. Like, I want my return to be soon. I also want my return to be more in control of my effort, less in control of global markets. So, like, okay, like for instance, let's say there's like a diesel truck, right? A diesel truck, low mileage, goes at the auction. I can nab it for cheap. If I can flip it on a 30-40% premium within like 2 months, I mean, you know, that's you got, I mean, those are juicy returns on something that's more affected by me and my work rather than, you know, global economics or other businesses' policy. Trick hanging out with us. Trick, we're talking investing, what to do, our plays in 2024. Dargenton says, thanks for keeping up with the facts and helping me understand this mad market. Thank you very much. D. Artigan. Everyone give a big thank you to D. Artigan. Sorry, I'm Dartigan. I can't talk. Dartigan. Hopefully I'm saying that right. Helping us out from Canada. Thank you very much. Larry B. also D. saying is my deal for the most part, but I'm checking out swing trading. And that's, and like, don't get me wrong, like I'm still hip to that action. I just need to see more liquidity in the market and more news events, Larry Bial. Digital Revolution comes in, says dollar hype bubble. Yeah, you know, that's what I'm talking about, all the assets being overvalued, but I think everything is overvalued. Why? Because look at inflation right here. In Europe, you're seeing the same. Europe is a mess with inflation. For all my fans watching from across the pond, from all my EU, European nation, my Euro fans, dude, inflation in Europe is just getting rough, and now we're rolling into winter where energy prices are going to just be hitting it even harder. So there's definitely some big global concerns in, all right? And the big global concerns that we have are based on a lot of things that are out of our control. And that's why I'm saying you can control and you can invest and you can have a little bit more control of your money by the effort that you put in, not just relying upon others out there. We've got 19 minutes until Jerome Powell comes online for the speech. Let me know what you got question-wise, topics you want to hit. We got Trick in the house, Larry B, all Nico, Dartigan, big support from the channel. Thank you very much, everyone. Now, some of the things that I'm wondering what you're curious about. XLM, you see the big bubble I got right here, right, for XLM price action? Reason I got that XLM bubble right here is because what happens during this time? This is leading up to election. That's what this bubble leads into. What is happening up into election time? You know that, man, politics are going to go nuts here. And seriously, this affects global markets. This is what really sucks with this stuff, is you've got this election bubble here, which you know no legislation is going to get done. None of it's going to get done. So now, when you look at, in terms of like asset classes, investing in time frames, right? This channel is about education, right? What's up, Mark? I see you chiming in there. When you talk about, investing in time frames and like us just sharing information with each other, that's what we're doing here. We're sharing information. Do you want to have that long of a time frame locked up where you don't have control? Recovery drink. Let's not freak out, everyone. It's too early for me to hit the hard stuff. Nico chimes in, and Nico, I'm liking what I'm reading here. Nico says another approach to consider is buy farmland with minimal maintenance costs, and you could rent it out to farmers. That's the other thing I was thinking about too. So I do live very, very rural. And there are some plots of land here, okay, that you can use for different types of livestock. And I've thought about that too. I even thought about that as well, is passively renting that out, saying, hey, all right, cool. Now, granted, you'd be out that money for the year, which I get it. But, I mean, I lots of ideas, lots of thoughts. Thank you for sharing, Nico. I mean, I'm thinking about it too. Ed Swayatowski has got a question a lot of us are thinking. Sam C, I see you there. Sam C says, keeping the daily workout going. Good for you. I did a daily workout yesterday. I did 2 workouts yesterday. I got 2 workouts today too. It really sucks. Ed Swayatowski says, I'm curious as to what you think about XRP versus the IPO and which will go faster. I think the IPO would be the biggest pump and dump that you've ever seen. I think the IPO you would see launch very similarly when they did the grayscale products. When the grayscale products first launched, they took off, and then it just plumped down into the shitter. So I guess that's the thing. The IPO, we would get more insight into the company. The IPO would be juicy. Would I buy the IPO at IPO price? No, I would not. Why? Because I think the IPO price would be inflated with the hype. The other problem I see too is that I'm telling you that, and this, like, again, this is just my feeling, but I've seen this play out how many times now. I believe the IPO, you would see a huge pump in the beginning of people getting excited with it, and then when it doesn't moon, because I think you'd have a lot of that, quote, moon mentality with IPO brought in, not realizing there's circuit breakers, not realizing that there's a lot of big money that comes in institutional-wise that does not go with that. Then I think the people would be like, okay, we're not seeing the crypto moon action we thought with the IPO, that it would come down. And then after it comes down, after the dust settles, then I think I'd be interested in it. I do. I think I'd be interested in it then. So for me, the IPO, I wouldn't play it at IPO launch. And I wouldn't play it IPO near term. I would wait for the effects, the oscillations, and I would wait for it to become a little bit more stable. Then I would get involved and look at it more long term. I think the IPO launch would be kind of, I think there'd be a lot of speculation in there and a lot of short-term speculation. It'd be great for the stock market. Yeah, trick. Yeah, IPO dip and tip. Yeah, and that's my thing. Like, I don't think I would play that one. I think I would just sit it out. Yeah, I would wait until the IPO cooled a while. Same, that'd be my thinking too. I would actually, what I would almost say, Larry and Trick, is if I were to play the IPO, I would actually look at maybe like their first couple quarters of filings after they did the IPO. And I would look at that, and I would look at those first couple quarters filings, and I would say, okay, what are their financials looking like? Are they making changes? Are they doing things right? That would be my play. Digital Revolution says pre-IPO on link to. That's not my thing. There's no way I'm going to do that. That is the most speculative market out there, a pre-IPO. And IPO is risky enough. You know how many, there's been plenty of IPOs that have flopped. Plenty. Oh my God, there were tons of IPOs. Hey Klaus, I'm thinking of taking my coins off the exchange, taking them some wallet. Thoughts? Yeah, be careful with exchanges. I think the problem with exchanges right now is exchanges are going to be facing liquidity issues, okay? They're going to be facing massive liquidity. No one's getting into it. Like no one, like the exchange volume. I just did a thing on Coinbase. Here, let's. You guys want to hang out with Edgar really quick? Here, let's hang out with Edgar. You guys want to learn? We got time. How fast can we learn, everyone? All right, we got 13 minutes. Let's learn. All right, let's do this. So let's go Coinbase, okay? So what we're going to do is we are going to find Coinbase. All right, give me a second here. COINB. Sorry, wrong one. I got to put it in the right search phrase. Coin. So we're going to look at Coinbase Global, okay? The reason we're going to look at Coinbase Global is I want to show you their quarterly reports. So give me a second. I'm just doing this on the fly. Filing category, we are going to go to quarterly reports. 8K, no. These are all insider trading quarterly reports. Hold on. I'm trying to find there we go. Let's open this fucker up really quick here. Oh, hey now. Sorry, I'm trying to find the right one here. But anyways, it comes down to volume, okay? And there's just like no volume on the exchanges. And let me just kind of show you. This was the one ending in June. There's a sooner one than this. Let me see if I can get the more recent one for you really quick. I am looking for, hold on, where did I see it? I'm looking for, I don't want the one from June. Yeah, hold on, here we go. I don't want the one from June. New report quarterly. Here we go. Give me a second here. Here we go. This is the one I was talking about. So, okay, when talking about bringing the money on the exchange, the crypto exchange's trading volume fell around 17% sequentially and about 52% year on year. Okay, so that's a big fall in volume. Now, look then at the amount of cash that they have on hand, and I don't have the most recent one. Let me see if I can find. Let me see if I can find the most recent one for you super quick, because then I could tell you everything you need to know. Hold on, 10Q. Let's see. All right, which one is this? So, okay, so they haven't posted the most recent one. But the one that they do have on file, give me a second here. The one they do have on file talks about how much cash they have on hand, cash and cash equivalents. They got 5.1 billion. So, I mean, it's up to you. Do you want to risk 5.1 billion? Robert Melvin says, wait for the dust to settle and look at the data. I agree. And see, okay, do you see what I just did? I went into Coinbase. I verified their filings really quick. I see that they actually have more cash and cash equivalents on hand now than they did since December. So they're adding to cash. So you have an exchange that's adding to their cash balances. Now, don't get me wrong. They have liabilities and all that. And they also have revenue issues. As you can see, the revenue is falling like a fucking... Ooh, sorry, I did not mean to swear. My bad, everyone. Their revenue is falling like severely bad from 1.9 billion in 2022 to 2023 being 1.4 billion. So they're about $500 million plus off. So now with the Ripple IPO, okay, the Ripple IPO, we would be able to do this, and that's when I would get invested into Ripple's IPO. I would get invested once I could see a couple of their reports, just like this that you see up on the screen. Hold on, let me get me out of the way. That you see up on the screen here, and you would be able then to see how much cash they have on hand, what their expenses are, how much they're spending on marketing and stuff like that. You'd be able to watch it. Larry Bial says, feel it, Klaus. Yeah, seriously, I think this is kind of how I would play it. I would wait, and I would just dig the financials like this. Because what can happen is you can go through this stuff and you could check out how much they have in customer custodial funds. So look at this. Coinbase right now, as of the second quarter in 2023, had 3.8 billion in customer funds. So you talk about like people putting, like stuff like off-chain, on-chain, like that whole thing. I mean, there's still $3.8 billion worth of customer custodial funds that are on Coinbase. As of, that was second quarter. We're waiting for third quarter. Digital Revolution says USDT is a time bomb. I agree. But Money Printer go burr, fake it till you make it with USDT. Vlad says, hello, good sir. Well, hello to you, Vlad. But yeah, I would, man. I would be so I would be into a Ripple IPO because you would be able to see numbers like this. See, like right now with XRP, you have no idea what manipulates the price of XRP. When it comes to like these companies' financials, this stuff gets audited. This stuff like has to be like legit. It has to be proper, or they are in the deepest amounts of trouble. They can have problems with their shares. I mean, they don't even risk that kind of stuff. So we're talking about Ripple IPO. We're talking about Jerome Powell finances. Investing. I mean, hey, if you can make 20, 30%, 40% maybe max, 20, 30% more than anything, say 20 to 30%. Would you lock your money up for 18 months to make 20 to 30% gains? Let me know right now. Right now, let me know in the comments. I want to see this. Would you lock up a good chunk of money for 18 months for 20 to 30% gains? Sniff's in the house. What's up, Sniff? How's it going? We're waiting for Jerome Powell and the Fed. We got about 7 minutes till JP comes on the mic. But that's the big question. We're talking about investing. We're talking about funds. We're talking about crypto. Buying farmland, renting it out. Companies that go public. Companies that go public. They file this stuff. You can invest with more insight with this. Trick says yes. Sean Lee, yes. Robert Melvin, no. Robert Melvin doesn't think that's enough juice for 18 months. Christopher Williams says yes. The question I'm asking is, would you lock up a good chunk of money for 18 months? That'd be about the return time. 18 months for 20 to 30% gains. Is that a good return for you? That's a really good question. Carrie Trotter says absolutely. So I see, and that's what you got to look at, right? You got to look at what is it worth for you, right? When we're looking at crypto, when we're looking at investing, when we're looking at buying land, when we're looking at our dogs barking in the background. Yeah, Trick says don't get greedy. The only thing that bothers me though, Trick, is like your money would be locked up for a year. Martin Ribbons says, hi Klaus, I'd like to know what you think of Quant. I like Quant, but again, we have to go to usage of the utility. I think that's a big problem, Martin. Great question though. I do. I think a lot of these have really good utility, but we got to see more usage of the utility. I'm going to make a t-shirt that says pumps and dumps and usage of utility. Trick says excellent return. It is. I do. I think 20 to 30% on a year play. The minimum return, Trick, just to let you know, the minimum return would be 3 months at 3% plus fees. So you'd get like, it'd probably be close to like 4% at 3 months. At 6 months, I think it's like 5-ish%. Mark comes in and says, glad you made the time for the live stream. Thanks, Mark. Thank you very much. Everyone give Mark a big thank you as well. Digital Revolution says, bond market's too volatile now to lock up in fiat. Yeah, you know, and that'd be my thing. I wouldn't, okay, put it this way. I wouldn't take that chunk of money and I wouldn't put it in a CD. Right? I really wouldn't. And again, thank you, Mark Sintic, for supporting the channel. Made time, yes, of course. Jerome Powell set to come on the mic in 4 minutes. We're talking investing here. Time that you lock up and stuff. So I guess that's my thing. It's also risk versus reward. Trick, I keep coming back to your thing of excellent return. You're right. You don't want to get greedy. But do you want to lock up your money for 18 months? Nico says, my shirt will say no utility, no liquidity. Sooner or later, these going to start sounding like names on Pornhub, everyone. No liquidity, no utility, no liquidity. Man. Starring Cindy Crypto. Yes, Mark, greatly appreciated. And I think that's what a lot of investors are doing right now. So this bubble, right? This bubble that we got right here means that this is there. You're not going to see any legislation in regards to crypto. Now, the new session of Congress wouldn't come in until 2025. Oh, I just lost my bubble. Wouldn't come in until 2025, so that pushes out here. It would take a couple months to get a little bit of regs going on. Let me move this up here. Would take a couple months. So you got to blur it out this way. So same thing. If you've got an 18-month window, right? Tricks is 20 to 30%. You lock it up, and that's the minimum. The minimum trick would be a 3% return if they buy you out. If they buy out your payment, was 3%. Carrie Trotter, super supporter. Thank you, Carrie Trotter. Nico says only coins. Come on now, Nico. Only coins. That's okay. Come on. That makes my cheeks hurt. That's really good. Everyone, give Carrie Trotter a big thank you for supporting the channel, becoming a super supporter. Nico says, then use the wife's money for 18 months. Well, no, I mean, it's not like I'd be like killing all the money. I'm just saying, like, when you lock up money, I just always worry about liquidity. 18 months is a long time in the crypto market. I might do it now if I felt I was confident like I'd come out again around the expected top. Mark says, I've been gambling on Turbo. So far, so good. Ooh, nice. Yeah, I mean, there's a lot of things to think about. 3% minimum return, okay, short term. Then you get your money back. It's reloaded to you in 3 months, so that means come February. Are there other assets that are gonna be even lower? When we're talking here, let's pretend. Let's fast forward, okay, everyone. Let's fast forward real quick. Next year at this time, are things even cheaper? Let me know. Let me know in the comments what you think. Next year from now, are things cheaper? Are homes cheaper? Will there be more stuff on auction? Will vehicles be cheaper? I'm very curious what y'all think, right? Or is this the bottom that we're living in right now? And that's the thing, right? So a lot of people are doing this. They're strategizing. Should we build up cash? Vlad says, for 20 to 30%, it has to be 100K plus to be worth. Not that many can afford to lock up for that period of time, considering times. And that's exactly my point. Is if you're going to lock up a chunk of funds on buying a house, buying a farm, buying land, doing stuff, you get some good juicy returns. 7% on a wallet staking Solana, good for you, Werner. Werner should be Werner. Yeah, we're talking finance. Talking crypto, talking your ideas. We're waiting for Jerome Powell to come on the mic. Where is he? I don't see him just yet. Not yet. Waiting for him. Should be coming up any minute. And when he does, we will go to the feed. But yeah, I do. I think it's a lot of time. P2P, yes. Retail, no. Yeah, for crypto to go retail, that would be a great usage thing. I think the thing with usage, we would have to go back to the usage of that utility. You still don't see a big use for crypto on a daily basis, other than speculative trading, right? Speculative traders send a lot of money back and forth. When you look at like the chains out there, that's like the biggest thing, people changing stuff. Nico says 20% cash, at least have some dry powder. Yeah, that's the other thing too, right? You don't want to go too deep. Yeah, and that's the whole thing. So that's where that's where I'm just considering right now, Nico, is how much do you want to lock up for an 18-month period? 12 months, 13 months at the earliest, like 13, 14 months at the earliest, more likely 14 months at the earliest. 14 to 18 months. Tough one. Waiting for Jerome Powell and the Fed to go live. Once they do, we will bring the feed in to you. What are we expecting? We're expecting Jerome to be hawkish, dovish. Hard to say. CPI data hasn't been too juicy lately. Trick says 100K. Messi, Leo says, I'm late. What's happened? Nothing yet. Waiting on Jerome Powell. Come out. The speech at the Economic Outlook at the Economic Club of New York. Nico says farmland is your safest bet. Yeah, and I do. I live very agriculturally. Which, that could obviously fit. Messi says, like the live. Thank you very much. Hold on. Their feed's just coming in now. They are a little blotchy. Let me, their feeds, this is like, their feed is actually like really, really crappy right now. It sounds very blobby, very blocky to say the least. Let's give them a few seconds here, see if it gets any better. Yeah, they do not have good sound right now. Jerome Powell has not yet started talking. We're going to wait to see when he gets on the mic. As of right now, they got someone up here talking, and yeah, we'll see what he says. Steve says, what's up? What's up to you, Steve? Messi Leo likes alive. Is he who prints the almighty dollar himself? Almighty, no. Let's see. See, get a little sound. See if their sound is any better. Oh, their sound is horrible. Oh, this is not good. Oh, yeah. This is... Yeah, they do not have a good sound feed at all. I mean, it is really, really bad right now. And this is coming directly from the Fed, so this is the main feed right now. And I mean, this sounds horrible, absolutely horrible right now. Let me just chop back in. XRP Firebird, entry supporter. Everyone get XRP Firebird a big thank you.
That state fiscal issues.
Wow, their feed is really bad. Let's turn down the visual just a little bit and see if we can squeeze more out of their sound. Wow, this is a... Yeah, I think they realize they have a bad feed because now... Get out of this stupid ass commercial. So you guys are seeing what it's like to do one of these programs live. It is not fun. It is not easy. All right, well, their sound is not good. Yeah. Okay, so here's what we're going to do. This is what happens when you try to do things live and things don't work as they are planned. You adapt, improvise, and overcome. So what we're going to do, we're going to hang out. We're going to talk crypto. We're going to talk investing. We're going to hang out still. Every once in a while, I'm going to chime in and see if their sound is any better. Their visuals are looking better. All right? I can tell you that right now. Their visuals are at least looking quite a bit better. I don't know what the hell is going on right now. So, but their visuals are looking better. Hold on a second here. What is going on with this thing? Do I keep hitting the wrong button? Damn it, I do. Now they have no sound whatsoever. Something is happening at the summit. It looks like, oh, yep, looks like they're shutting it down. You guys, something is going on here, and we are watching this live right now. They have shut the lights down at the summit. We're watching this breakdown. They have not shut the feed down yet. Oh, they just cut it off. Did you guys catch all that there? Here, I'll show you what happened. Something happened here at the end. Here, let's watch real quick. Something happened here, and I think. Oh, listen. Okay, look, this was completely raw. Look, they had protesters come in. You see them here on the right of my screen? They had protesters come in. Check this out. So you have sound right here, right? The sound really sucks. Damn it. Why do I keep screwing up and putting on the wrong thing? The sound really sucks. right? Now all of a sudden, look, there's no sound period. These people come up on stage. Look at this. These people come up on stage. They're right here on the right. Look, there's all these people filming them right here down on the screen. What the hell is going on? Here, look, they're right here. They go dark on the event. They cut out sound completely. Look, there's their mic up there. They have now gone completely off. Then they sign off. What the hell is going on, everyone? You watched it live, and we're going to keep watching it live right now. The Economic Club of New York has had some protesters come in and just completely raid out the event. So, yeah, hey, live TV, man. This is the fun of live TV. So what we're going to do is we're going to leave this live. If something happens, we will come back to it. I don't know what the hell to tell you all right now. The host ended this meeting. Well, we have a big problem here, everyone. It looks like they shut the thing down. So, yeah. I mean, yeah. Yeah, okay. Okay. I mean, like, what do we do? Like, protesters come and ruined our live stream. Like, okay, well, so Jerome Powell was going to talk about stuff and stuff was going to happen and you watched it here live. I don't know what the hell that was. There was some people that came in the room. We've got it live on the stream. The sound was garbage, right? The sound was all garbage. It was very pixelated with this gentleman here talking. Then the visuals, they cleaned up, okay? It cleaned up. Now watch this here. Let's go full screen. Watch to the right of the screen here and watch their reaction back here as this goes on. This is, okay, you're going to see it happen. All right. There you go. Look, you saw the people, right? They were just coming down on the bottom of the screen. Here you go. They're all looking up here. The guy's like, oh shit, what the is going on? Look at this. Here comes a whole bunch of them. He stops talking. They kill the sound now. They kill the sound. Look, there's two women right here. The one, she just gets up on stage like, yo, girlfriend, go off. This girl here, I don't know what she's doing. He's like, yep, security, can you deal with this bullshit? You guys, we have seen it live. We have seen it live. This is crazy. And so you can see it. He's like, all right, everyone, you need to get the F out of here. Look, they're filming it. So as soon as they see that happen, they shut the lights down on the event. This dude is like, y'all need to get off the stage. You're ruining Klaus's live stream. Why are you ruining Klaus's live stream? He's telling him, look, his friend comes up and is like, yo, you're ruining Klaus's live stream. Get off. They then now go to this. This is crazy. All right. Well, what we will do is we will hang out. I don't know. We'll hang out. We will tell campfire stories. Like, dude, that was nuts. We've got this live. We watched it all live. That's why we share these live streams and do all this stuff. This is crazy. Like, what the fuck, man? Like, I just wanted a normal live stream, right? And then we see this kind of shit happen. Well, we got Bitcoin sitting at 28,760, ETH at 1565. XRP, you want to talk XRP IPO until these nutbags come back on stage? Because we're going to make sure that we're live here. We're also going to open up a secondary channel here for the SEC. Yeah, like exactly. Let me be, man. Like, let me be. That was jacked up, dude. And the thing was, the sound sucked to begin with, right? The sound was just complete balls to begin with. And then all of a sudden, like, the visuals got better, but then they completely just blew out the sound. You want to talk XRP IPO? I mean, come on now. Like, this is crazy. Totally crazy. So anyways, that's the deal right now with crypto. We are talking inflation. We are talking CPI data when it comes out next, November 14th, everyone. When does Jerome Powell and the Fed come out and meet? October 31st, November 1st. Twin Force Fusion says, wow, banks are quitting auto lending. We got SEC filings. Actual Life Aquatics says, balls. Balls is right, man. You guys ruined my live stream. Whoever you protesters are, you people right here. You people right here, you ruined my live stream. All right, it says CNBC is live. Try their Klaus. Let's see if we can find a CNBC live feed. All right, let's see. CNBC live. Let's see what we got here. If this is good, we will jump on over to this one because that was just very, very funny. All right, let's go live here. Waiting for a commercial. See the fun of live TV? Like this is just the fun I have as a live creator on YouTube. And you guys get to see it, like the unedited fun that I get to have. All right, so yeah, here we go. So yeah, nothing is happening as you can see still. The event is blacked out for now. I'm going to open up a primary Federal Reserve feed. No, we're not going to watch House of Pain. So Federal Reserve, we're going to have that one up here in the background. So yeah, there you go. CNBC Live. This is the look now from CNBC's feed. So let's go to that. This is what it looked like when you were watching CNBC. Uh-oh. He's like, come on, guys, get off the stage. Here we go. Quite a few people up there. This is what the ruckus looks like. Let's talk Count of Monte Cristo. I know, this is balls, man. All right. Nice rigmarole here. And they had these people up on stage for quite a few minutes. Boy, what kind of security they got going on in these events right now. So, yeah, lights are still blacked out. I'm sure they're talking with security like, guys, what the hell happened here? Like, come on, this is bad. All right. Yep, so we got the live feed going on. You can see they're still not doing anything. Oh, what a frustrating day. No more oil, no more petrodollar. You know what, though? What is the U.S. really done with energy dominance? Edward Barecki says, would anyone take money out of the market to buy XRP? Any thoughts? Market seems like they're playing with our money. Edward, that's what we've been talking about today. Investing money. If there's this uncertainty and if you're not in control of it, right? If they weren't in control of it, where are you going to invest your money? Good question. Bo Rabbit's in the house. Larry Bell says, any idea what they were chanting? No, they killed the sound on the feed before the people got there. That was like the first thing they did. Organized chaos as always. Yeah, I mean, hey, you know, it's what happens. All right, he's getting back up on the mic. Let me see what this one, because I would rather go to the Fed directly. But let's see what this guy says.
The good news is I'm not going to repeat the introduction, and we'll start off.
Here we go. Go back to it.
Jay is going to speak for a few minutes and will provide opening remarks, and then he's going to be followed by a conversation with Bloomberg's David Weston. David is the esteemed anchor of Bloomberg Wall Street Week. This conversation is on the record, and we do have media on the line and in the room. Let's welcome Jay to the stage. Jay, for you.
Thank you, Bob. Thank you, Bob, and thank you to everyone for being here today. It's great to be back at the Economic Club of New York, where I last visited before COVID. So before our discussion, I'll take a few minutes to discuss recent economic data and the outlook for monetary policy. Incoming data over recent months show ongoing progress toward both of our dual mandate goals, maximum employment and stable prices. And I'll start with inflation. By the time we raised rates in March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand, and also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1% in June 2022, 12-month headline PCE inflation is estimated at 3.5% through September. Core PCE inflation, which omits the volatile food and energy components, provides a better indicator of where inflation is heading. And 12-month core PCE inflation peaked at 5.6% in February 2022 and is estimated at 3.7% through September. So clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging. And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%. But these shorter-term measures are often volatile, and in any case, inflation is still too high, and a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains, in conjunction with the rebalancing of demand and supply in the labor market, has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic activity, employment, and inflation. Financial conditions have tightened significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above-target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation, David.
Thank you very much, Chair Powell, for being with us today, for the remarks, and for having a bit of a conversation here. We really appreciate it. It strikes me it's a particularly propitious time, given everything that's going on in the world and in the economy. There's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
We've heard other people speculate that maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control, they come to us, and we conduct policy always to achieve maximum employment, and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
How much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50% in terms of seeing it in the effect in the real economy?
So there's no precision in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
In order to conduct monetary policy effectively, do you need at least a hypothesis about how much has already hit the economy? Because it's hard to know how much more you need to do if you don't know how far you've come.
So on lags, I think if you think back, it's been a year since the last 75 basis point hike we did. It was at the November meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't all just arrive on one day. They arrive and then they're thought to peak and then to diminish. So there's a lot of uncertainty around lags. And one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long-run growth is? Long-run
potential growth is not something that moves around a lot over time, but my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour, productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be, and I think it's very hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, and so lots of savings and relatively with an aging population, savings greater than investment, so rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. I mean, this is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate. I mean, my guess is it'll be somewhere in the middle, but I don't know. I mean, I think we can say this now. The effective lower bound is not an issue. You know, we were very concerned about that. Right now, we're very far from the effective lower bound, and the economy's handling it just fine. But that's because we're at a time of really elevated demand coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it basically. The idea was, I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of theory.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections. And that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25% to 5.5%.
Do you think we're entering into a new phase in monetary policy? We had the Volcker disinflation, I think you referred to it as, and then we had sort of inflation targeting for a time. There was concern about secular stagnation. We were pushing the zero bound, as you said. We were concerned about that. And then we had the pandemic, and we had the real problem with inflation. What's the next phase look like? How would you describe it?
What we've been through is, in all of the advanced economies around the world, was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates to the effective lower bound, which is zero or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to zero in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And the most common answer was some kind of a makeup strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And, books are written on this subject now. You can argue that, and some have argued that effectively the last 20 years before the pandemic were kind of a perfect storm of disinflation. And now that's all gone, and we're going into a more inflationary period that will be characterized by more supply shocks and things like that, and therefore more inflationary pressure. So Are we going into such a, I don't know. I mean, all I can tell you, I think it's unknowable, and, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what do we learn? Sort of an after-action report. Look at the pandemic and the pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people and that we wouldn't have a vaccine for 5 years. We might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s. So it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much of assigning blame or saying, did somebody make a mistake, as are there things that going forward would change the way you conduct monetary policy that you learned from that maybe nobody had reason to know at the time, but it was an experience you went through?
Well, we were in a time of a very long time, in a reasonably long time, of disinflationary forces. And I think everybody's instinct had been attuned to risks coming from this direction, which is too low inflation. And so what this has taught us is that now that period is over, and we now have probably going forward a more balanced set of risks where high inflation and low inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that, and events are the possible range of events is so much wider than what we think it is on any given day, right? The tails are so wide, and it's just not human nature to constantly be thinking about things that are way out in the tail, but they happen in financial markets and in economies. They happen far more regularly than they should.
I suspect every person in this room is well aware of what's going on with yields with bonds. It's been a big story, particularly in the longer end of the curve. What is your understanding of what is going on in the bond market and why those yields are going up, particularly, again, at the longer end of the curve?
So it's really two questions. One is why is it happening, and the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer-term yields, but this is what I think we can say. First, what it's not. It's not apparently about expectations of higher inflation, and it's also not mainly about shorter-term policy moves, so Fed funds moves over the next year or two. Really, if you can look at the 2-year, for example, and 2 years moved up a little bit since September, but really the move is in longer-run bonds. So it's really happening in term premiums, which is the compensation for holding longer-run securities, and not principally a function of the market looking at near-term fund rate. I think a few other ideas about, there are many candidate ideas, and many people feeling their priors have been confirmed by this event, I'll say, as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term this may require higher rates. That could be part of it. There may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. If we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up. So all of those are possible ideas. Then the question is, does it matter for us as long as I'm talking about this? So the way I think about it is, we change our policy. Actual and expected changes in our policy affect financial conditions, and persistent changes in financial conditions affect economic activity, hiring, and inflation. So one question is, are we seeing the longer run bonds, the increases in rates, are we seeing those come through in financial conditions in a persistent way? And I think if you look at financial conditions indexes, the answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous? And is it just because the market expects us to take things, to take further actions to tighten monetary policy, in which case if you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is...
Bottom line, though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
Well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be, that would really, this is the future that we're looking at now?
Well, so of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So, for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a long term. I don't think we know. I think, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, markets have been volatile. They've been longer. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But for now, it's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane, you're not responsible for fiscal issues. At the same time, you have to take into account, and it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer-term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else. I just came back from IMF meetings this weekend, and there's a lot of talk of the very large resource demands that organizations like the IMF and of course countries are facing, and the need for substantial amounts of revenue. You mentioned military. There's also dealing with climate change and things like that. So there's a lot of that. We don't, as you mentioned, we don't comment on fiscal policy. Actually, the fiscal authorities have oversight over us, and not the other way around. So we stay away from that. So I would just say everyone knows that it's not a secret, and about all I can say is we know that we're on an unsustainable path fiscally. It's not that the level of the debt is unsustainable. It's not. It's that the path we're on is unsustainable, and we'll have to get off that path sooner rather than later. It's not really something, though, that affects a monetary policy decision about how much we raise rates in the next 6 months. It's not going to be driven by. If there were some vast new fiscal policy that were about to be enacted, and then that would have an effect on the models, and would have an effect on projections, and indirectly that would affect us. But we would not be in a position of responding directly to fiscal policy.
When we talk about the treasury market, obviously there's buying and selling, and the United States government is issuing a lot of treasuries. there's also a question of who's buying. And we now have one buyer who stepped out of the marketplace, namely the Fed, which is a big buyer. At the same time, we're getting reports that maybe some of the overseas buyers may be pulling back as well. How do you take that into account in assessing where we're going with long-term bond yields?
So actually, I think buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large they've been buying robustly. Again, we look at the broad financial conditions. We look at interest rates, other asset prices. That's what we look at. We don't focus on fiscal policy. We wouldn't change monetary policy because of, for example, because we think that the U.S. is on an unsustainable path. Everyone knows that. We're just going to do monetary policy to achieve maximum employment and stable prices, and that's how we think about it.
I'm curious, though, one of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see, there's some areas where spending is softening, but overall, look at the retail sales number. The consumer is strong. Volume's not going up very much, but companies are profitable. Now, if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down, and really the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on. We had the home builders in this week. It's a very tough time in the whole home building industry, and we know that. But ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide, and that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver, and this is the time. Our independence is not for times when we're really popular. It's for when we're doing something that really the public counts on us to do, notwithstanding that it's challenging and difficult, and higher interest rates are difficult for everybody.
You have not wavered from your commitment to 2%. You did again today, 2%. No question about it. There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect, they do. They're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case, actually. I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I think that remains to be seen. And by the way, I'm not blessing any particular level of longer-term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic, and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So that's where we were. So since then, there are very many signs that the labor market is getting back into balance, and I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, are workers plentiful? And that measure was no, but now it's back to...
Thank you very much for the support, Trick. And everyone, if you could, give Trick a big thank you for supporting the channel. Greatly appreciate it, sir.
Wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4. They were at 1.2 in the very tight labor market of 2019. By the work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, there was a very tight relationship. And that relationship went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it, and workers expect it, and you expect that in your shopping, then that's what will happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time. And the models were all saying that we should be seeing some inflation, and we never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now, I don't think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was really the collision of very strong demand, really strong demand, with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.
Let's turn to another responsibility of yours, which is the banking system. Last March, we had something of a scare because of, I guess, interest rate risk with Silicon Valley Bank and then some others. Are we through that now? Where are we in that process? Are you resting easy?
So what you pay us for is not to rest easy. We don't do that. But I would say where we are is this, though. Things have certainly settled down. We see the funding markets is fine. We see, and we paid a lot of attention to banks that looked anything like the banks that had the problems, and made sure that they had credible liquidity plans and plenty of liquidity and all of that. And so I think all of that has worked. And we set up this facility that's available for banks to borrow. And so all of that has led to a real settling down. But, our job is to be on the case, and, we're still on the case. And we'll keep after that. Banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform under Dodd-Frank and Basel III that we went through, with former Governor Tarullo, right. And many others. And so we benefit from a very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more. This is
You're
the
talking about
proposal.
The Basel III proposal, which is, it's a rule that's out for comment, so there's not a lot I can say, but we do expect a lot of comment, and we do expect to take those comments very seriously.
Talk about commercial real estate. There are some concerns out there in the marketplace of what's going on, because obviously there's a repricing that comes with your increased rates. It's thought that there's some real estate out there that is not worth the money that was originally financed with it. How concerned should we be about that as something lurking out there that could really affect the system overall, not just the people invested?
So there's work from home, and that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. Right. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is the supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and we're on that case, and don't see it as as presenting much broader problems. But our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere. And we've got the community banks, the smaller banks that we understand are critical, particularly for small businesses and local context. But what about the regional banks? How much pressure is there on them? And what would the damage be to the system if, in fact, there was more consolidation with some of the big banks?
I think the regional banks are very important, extremely important. We have 4,500 banks, which is a lot more than any other country per capita or per dollar of GDP. But we have, our GSIBs, the largest banks, are the leading banks in the world in profitability and in their success in their business. We have community banks who deal in smaller communities. But we also have these great regionals, and I think they do a great business with many companies, and I do think their business model is under pressure, and I would not like to see us add to that by treating them exactly like GSIBs. I think they don't need exactly the same attention that a GSIB gets. So, but I would say I personally think, and I think we at the Fed strongly think that the regionals and the smaller regionals are an enormously important part of our banking system.
Okay, you've been very generous with your time. Really appreciate it. I have one last question. Are you having a good time? And if so, why?
Now or?
No. I assume this wasn't that pleasant, but in general, are you enjoying your job?
I would say this. First of all, it's an incredible honor to do this job. And every day I do it, I feel so fortunate and so lucky and blessed to be entrusted with this. And, all I want to do is do the best job I can for the public that we all serve. And yes, there's a lot that is enjoyable about it, but mostly it's just so important to get it right, and that's what we're trying to do.
Thank you so much, Chair Powell. It's really good of you. Thanks a lot.
Thank you.
Golf clap. Hold on. Camera on. Golf clap. So Jerome said some very, very interesting things here, but the chat has also said some very interesting things. We're talking housing market here. Oh shit, I just dropped one of my things. We're talking housing market. Will the housing market pop in the next 2 years? I don't know if we'll get like what people would consider a pop in housing, because you have private equity groups that still just got tons tons of money still. Commercial real estate, right? We know that. Commercial real estate's the herp, dude. You know, I think what commercial real estate would go into the phrase like this. The happiest day is when you buy your commercial real estate. Your second happiest day is when you sell your commercial real estate. All right, I think that's a commercial real estate. I wouldn't touch that. Dumpster fire. So bubble popping with commercial real estate, yeah. In terms of housing, for us, I just don't know. You know, rents are high. You're seeing rents get raised in a bunch of places right now. There's still a movement to the suburbs. And that movement to the suburbs is very strong. And we're talking about work from home. So again, if your work from home movement is strong, that's going to definitely keep housing up. Why? Because, okay, well, I work from home. I'm saving money on gas, wear and tear on my car, stuff like that. I think that's all big. That's all big stuff. Hey, Klaus. Sorry for the personal question. That's all right, Jose. But I would like to ask, have you bought any pre-IPOs from Ripple and Uphold? No, I have not. We talked about Ripple IPO earlier. I will not touch Ripple IPO until they at least file a couple quarterly reports. I need to see some quarterly juiciness from them. But housing is going to be rough for a while. And again, I just want to take the opportunity. The stream was going on with Jerome talking. Again, Trick, thank you very much for that. I do appreciate it. And thank you to everyone that thanked Trick for the support of the channel. But housing, I don't know. Housing is just getting out of control. And that's, okay. So what we talked about before Jerome Powell went on live was exactly that, was housing. There is a real estate auction. My county's tax auction is happening. And there are hundreds. I could actually tell you how many there are. There are over 1,200 auctions, items for auction, real estate and houses. It just in my county, okay? So I'm sitting here thinking, and we're all sitting here thinking the same thing, right? Is housing going to pop? Should you buy places, rent it out, knowing that the rent is still way up there? The rent is going to stay up because interest rates are staying up, because that's pricing these people out of buying new homes, because now not only are the interest rates up, but people have to put more money in. People have to put maybe 20% down. So now they got to put 20% down on top of high rates. Thank you, Trick. Trick says, no worries, Klaus. Appreciate that. So Vlad says, I just moved from Ireland back home in Romania after 15 years, and I'm in the market for a house, but I'd rather rent than buy it. Works out much cheaper prices. Yeah, I get that, but rent out, and again, that's the big problem by us, is rent is going up by us way too much. And with rent going up, it pulls housing prices up. Housing is considered one of the safest places to put your money. Even though housing at times can be volatile, over the long run, housing proves to be very, very good for people. So a lot of these private equity groups really slap big into houses, big into housing, because they know they can get that generated income. And then when they want to get out of it in 5, 10, 15 years, they could sell that house for X% more. So they make money in the current, and they also make money when they cash out. So a lot of these private equity groups are going to keep feeding houses. Digital Revolution says, without XRP, you will learn to eat bugs and be happy. No, I will be hunting. I know how to hunt. I know how to skin. Freddie says, not in the UK. Can be 50% cheaper, saying that rent is not cheaper than mortgage. Yeah, Freddie, we've been talking UK housing too. And across the pond, housing's a problem. I mean, it's too much money being eaten up. So like I'm sitting here, right? I'm sitting here and I'm in front of a crypto heat map, okay? So this crypto heat map, we're looking at it. It's in the background, over my shoulders, right? Retail fuels crypto. If retail fuels crypto and housing is just starting to price people out, people need a place to live more than they need a place to put their money. And I think that's where you're seeing a big problem to the crypto market, is because of retail, because of all the pressure on retail, because of private equity groups. Because of all that, you're having more issue. Way more issue. Digital Revolution says banks are in trouble. I don't know, according to Jerome Powell's saying banks are in good shape. Banks have a lot of capital. So what's happening with banks is very similar to what you're seeing, what's happening up in the the economic earners group, right? What's happening is $2,500 for a shoebox. Yeah, I could see that. What's happening with banks is your well-capitalized ones have so much cash on hand because of what's happened over the last several years that they're able to withstand the storm, okay? Same thing with a lot of families. There's a lot of families that have a lot of cash on hand that can withstand the storm. But your banks that are in the worst trouble, your people that are in the worst trouble economically, right, that have to borrow, that don't have all that, they're in trouble. They are in lots of trouble. And you're starting to see that move up the economic and banking ladder. All right? That's a big thing you're seeing right now. You're seeing that debt, which started off in the lowest of income families, start like ballooning during Rona times, right? They started eating up, stuff and started taking on debt. You started seeing debt in the lower income families now spread to the lower middle, now to the middle, and you're starting to see that debt reach up the ladder. And that's what Jerome Powell is talking about, is there's a lot of the economy that's very strong right now. But there's some debt that's starting to creep its way on up. That's a big problem. All right, here's what we're going to do. We're going to end the live stream at 1:15 today. So we've got 7 minutes for you to ask your questions. Hit your comments up. Now's the time. We will talk anything from public reporting of juicy goodiness, CPI data, Jerome Powell, Code 9 says it right. We need institutional money. We do need institutional money for crypto. You won't get institutional money for crypto because there's no insurance for it. And as long as we're having all the hack scams and schemes, institutions, they're not going to have insurance. They're going to stay far away. Ooh, sorry about that. I should have muted my sneeze. My bad on that, everyone. So yes, we do need institutional money. You're going to have a tough time getting it, though, when there's no protection. Murda says, what's up, Klaus here from Texas. What's up, Murda? How's it going? Texas fans in the house. Love it. Yeah, inflation is going up. Prices are going up. And that's the other thing, right? We're talking about the need for institutional money. Well, so obviously we know that retail money is what props up crypto, but costs are going up for retail. Like, holy crap, man. Like, costs are definitely going up. And the 2% target's a joke, man. Totally a joke. DVR says we need that BS meter. I like that. I got to come up with some sort of like widget that when I do my green screen, I could throw the thing up on. Diego Sanchez says, hola, Klaus, how are your dogs doing? Great. The one puppy jumped on me during the Jerome Powell thing, and I had to bring him up on cam. Puppies are great. They just eat a ton. They just eat so freaking much. So we've got 4 dogs. 3 of them are rescues. And we're a huge dog family. Our last 3 dogs have been rescues. We're very proud of our rescue puppies. It's been a blessing, but holy crap, the 2 puppies just eat. And it's not just food, spatulas. I made some eggs, right? Like I made a little bit of eggs action, lately. But I was cooking and I left the spatula, boom, ate the spatula. This is literally the 5th or 6th spatula that these puppies have eaten here in the last couple months. Freddie says, you focus on news. Not a criticism, Klaus, love your videos, but do you look at macros in TA? Yeah, I do. I do look at macros. I look at macros probably more than anything. I'm macro and news heavy. In terms of TA, right now, TA is just very limited chunks of time that the data applies to because the economic conditions are different. And what I mean by that is when you look at the price of XRP, right? Let's look at XRP, okay? When XRP was really rip-roaring with some good dollar amounts, right? This was during some very different macroeconomic times. Money was a lot cheaper and a lot more people had money. Now, money is very expensive and there's not as much of it going around because interest is eating it up. You have less money flowing into crypto. So different macroeconomics. But yeah, good question. Enrique Ramirez says, I'll wait for XRP in February 2024, 38 cents. Yeah, do you guys think that we're going to be having a rough end of the year? Let me know what your thoughts are. We got 4 minutes until the end of the stream. Questions, comments, get them in now. We've been talking Jerome Powell. We've been talking the interruption on stage. That's right. It's hey, can't I just have a regular live stream? There has to be some hoopla rigmarole on there. But Freddie, great question though. Great question. Dude, Okay, and so here's the thing, and we don't want to get metal spatulas, Robert. We don't want to get metal spatulas because it'll scratch our, like, non-stick pans. So we get the plastic ones. Dude, I'm not kidding you. My wife was just looking at me like, Klaus, you're a fucking idiot. Because, like, I literally just made some eggs with a little bit of spinach in there, and then what happened was I left the spatula up on the counter, I pushed it all the way in the back. Well, the puppies are big enough now where they can reach up, grab, done. I suck. Yes, I do need to go to Spatula City. Damn, what? That's a good joke. I just got the Spatula City one. Robert, well done. Well done. It took me a while, dude. It took me a while. Well done, Spatula City. I like that. Good one. Very good one. Rough is an understatement. Very true. Powell's 2% target is equivalent to the cargo cult quote. When a measure becomes a target, it ceases to be a good measure. Very true. Yeah, I think Jerome Powell too is they're trying to just, I guess, wing it. I mean, he even said that a lot of the stuff, right? That a lot of the stuff that's going on, he said just isn't coming through their predicting states, right? That their models that they use just aren't predicting this kind of stuff. So yeah, I think Jerome's in uncharted waters. I think a lot of these guys are traditional finance people. I think they still believe that the economics move very slow and that the lag effect is probably longer than what it is. No, I think the lag effect is shorter, but I believe because they're traditionalists, like Jerome Powell is very much a traditional financial guy, he's going to look at it, and I think they look at things being a longer time frame, where I really think it happens shorter. Very good on that. 2 days ago. That's why it was fresh to you, Mr. Spatula City. That was pretty good. That was actually really good. So yeah, I guess that's my thing with Jerome. I think though that we're under more pressure because the prices keep going up. Charlie the Realtor. This one was not CPI. This was Jerome Powell's monetary policy talk, basically saying that banks are in good shape. We're going to raise rates more. The job market is stronger than they thought it would be. Their models haven't predicted things accurately. Pretty rough one. Freddie says, have a good weekend, Klaus and everyone else. Yes, thank you, Freddie. Vlad's giving the big thank you. Yep, like I said, last minute here on the stream. We've got questions, comments, bring them up. Now I'll hang out with the chat a little bit at the end. Digital Revolution says, Black Swan, liquidity crisis. There's a lot of liquidity still, Digital Revolution. The problem is the liquidity is being held by very high ups on the chain. Very, very high ups on the chain. There is a lot of money. There's a lot of money, but concentrated with very few. So the liquidity crisis is not just a liquidity crisis in who has the money, but it's a liquidity crisis in who has access to that money. That's very important. Oh, Charlie, that's all right. It says, my apologies of the work you do from the northwest suburbs. Ooh, hey, Charlie. Loyola guy right here. How do you like that? Northwest suburbs, Loyola guy. Actually grew up Lyle, Naperville. Throwing it out there for you, Charlie, for my Chicago fans out there. So that's the deal. Jerome Powell says the banks are strong. Says, hey, if we need to, we'll keep raising rates. Credit is blowing up. Credit defaults is something we're all talking about. Nico says he's got to go. Nico, thank you very much for the support, sir. I appreciate it. Charlie knows what I'm talking about. So yeah, that's the deal. All right, everyone. What I'm going to do is I'm going to play some tunage for you. You know the song. I'm going to hang out and chat a little bit. You cool cats, though, have a great rest of your day. Make sure you say goodbye to each other as well. Important to support each other in this mission.
my